Real income isn't about chasing the highest yield. It's about building an income stream that can actually keep pace with the cost of living over retirement. And you don't get there with one asset, one income mechanism, no matter how comfortable and familiar that asset feels. You get there through genuine diversification of assets, of income type, and of liquidity. Welcome to another edition of Perspectives, the podcast where we try and improve financial literacy for all Australians. My name is Pizzichetta, and I'm the founder of Mont Wealth. Our aim is to help you strategically build wealth for a self-funded retirement. I just met with a client for a coffee. We discussed how we can plan and build towards retirement. And it's put something on my mind and I think deserves more airtime, especially when it comes to retirement and income. We were talking about income, real income, and how that Mont Wealth Income Portfolio is put together. And the thing that kept coming up again and again was the idea that diversifying how you generate income is every bit as important as diversifying what you own. It sounds like it should be obvious, but it's not how traditionally most people built their income strategy. We're going to start with a concept I think is chronically under-explained: real income versus nominal income. Then we'll get into why relying on a single income engine, no matter how good that engine is a structural risk. And we'll finish by walking through the Mont Wealth Income Portfolio and how its construction is a direct response to both of these problems. So let's start with a question. If you've got a term deposit paying you 5% and inflation is running at 3.5, are you actually getting ahead? On paper, yes, you're up 1.5%. But here's the part that people miss. Your capital base on a term deposit is frozen. It's not 5% on a growing number. It's 5% on the exact same number year after year. Meanwhile, the cost of everything that number needs to buy, insurance, groceries, healthcare, energy, is compounding upward every single year. So the income might look flat and safe, but the purchasing power of that income is quietly shrinking. That's the trap of nominal thinking. A term deposit gives you income. It doesn't give you growth in income. And for anyone investing in term deposits thinking they are getting a 5% return, your real return is really only 1.5%. And for those drawing down on their portfolio for 20, 25, 30 years in retirement, that distinction isn't academic. It's the difference between maintaining a lifestyle and slowly eroding it without even realizing it's happening. So real income that's underpinned by assets that can actually grow their earnings over time, rent reviews, dividend growth, distribution growth from infrastructure and credit assets, that's what protects your purchasing power. The whole point of real income is that the income stream itself needs to have some growth engine built into it, not just the capital sitting still generating a flat yield. And this is where the conversation naturally shifts to how you actually construct income. Because it's not just about chasing the highest yield. That's a mistake. People anchor to the number. This gives me 6%, that only gives me 4%, without asking the more important question, where is the income coming from? And is it going to be there in 5 years, adjusted for inflation, or is it going to be smaller in real terms, even if the number on the statement looks the same? Now let's talk about the lesson a lot of Australians learn the hard way. This is the property story. For decades, the dominant retirement strategy in this country was some version of buy an investment property, maybe two, pay it down, and then either live off the rent or sell it down to fund retirement. And to be fair, for a long time, that worked. It worked while the conditions supporting it held. But here's the thing, that strategy has almost zero income diversification built into it. If your retirement income plan is rental income from residential property, you've got one asset class, one income type, and this is part that people forget. One exit mechanism. You eventually need to sell into a liquid market at a price that supports your retirement. And property is not a liquid market. It's about as illiquid as investable assets get. You decide to sell a house, engage with a real estate agent. If all goes well, you market it for a month, auction the property, and settle within 60 to 90 days. All in all, it might take 4 to 6 months at best to get whatever someone is prepared to pay for that asset. You can't sell 10% of a house. You can't respond to a bad month by trimming a position. It's an all in or nothing, lumpy, slow to transact asset. That's fine when you're one person selling one house whenever suits you. It's a completely different problem when you've got an entire demographic cohort trying to do the same thing at the same time. This is the baby boomer exit problem. You've got the largest and wealthiest generational cohort in Australian history reaching retirement age in a relatively compressed window, and a meaningful proportion of them building their retirement plan around the exact same asset class and the exact same exit strategy. Sell the investment property or downsize and live off the proceeds. When a large number of sellers are trying to exit a genuinely illiquid, slow-moving market at a similar point in time, And that coincides with the kind of drawdown, a rate cycle, a credit tightening, a demand shock. You get sellers meeting a market that doesn't have the depth to absorb them at the prices they were counting on. So it's not just an asset concentration problem, it's a timing and liquidity concentration problem. Zero diversification isn't just about being all in on property as an asset class, it's being all in on one income mechanism, one liquidity profile, and inadvertently, one exit timeline that shares with thousands of other people. When those three things converge with a market drawdown, you don't get a gentle correction, you get a genuine liquidity crunch for anyone who needs to sell on their own terms, which is the exact opposite of what you want your retirement funding strategy to look like. That's why the modern approach to income investing has to think about diversification on at least three dimensions: the type of asset, the type of income it produces, and how liquid or accessible that income and capital actually is when you need it. This is where Mont Wealth Income Portfolio comes in, and I think its structure is basically a direct answer to everything we've just talked about. This portfolio is actually allocated around two engines, growth and defensive, sitting either side of the same wheel. It's not just a list of asset classes, it's a deliberate balance between assets that grow your income ahead of inflation and assets that protect and stabilize it. Let's start with growth side. You've got a real asset of 22% in the portfolio. That's global property and global infrastructure combined into one real asset sleeve. Think about toll roads, utilities, data infrastructure, logistics, and listed property. A lot of that revenue is contracted or regulated, and a meaningful chunk of it is explicitly inflationary linked. That's a direct structural answer to the real income problem we open with. You're not hoping the asset class keeps pace with CPI. In many cases, it's contractually designed to. Both asset classes are generating circa 3.5 to 4.5% income distribution and growing their earnings between 6 and 10%, which leads directly to income growth, real income. Then there's equities on top of that. Australian equities at 14%, global equities at 12%, and a smaller allocation of private equity of around 4.5%. That's dividend growth and capital growth from businesses that over time tend to grow earnings and grow distributions. Private equity adds a value creation engine that isn't moving day to day with listed markets. So it's diversifying the growth sleeve itself, not just adding more of the same thing. So the growth side alone is already spread across four generally different sources: real assets, domestic shares, global shares, and private equity. No single one of these is anywhere near the concentration of one investment property. Now flip to the defensive side, which is actually the larger of the two engines by weight once you add it up. You've got private credit around 19%, the single largest line in the whole portfolio. That's contractual income, often floating rate, sitting in a completely different part of the capital structure to anything a term deposit or listed bond gives you. And because of that, it floats with the cash rate. It's another built-in hedge against inflation and rate cycles. Then domestic fixed income at around 13% and global fixed income at about 9%, which is your traditional bond ballast, and cash at 5.5% for liquidity and dry powder. So the defensive engine isn't just safe and boring, it's actually doing real diversification work of its own. Three different fixed income sources plus cash, not just one bond fund. If markets sell off, this portfolio has cash and high quality fixed income, both domestic and global, to lean on rather than being forced to sell in a liquid asset into a falling market. That's exactly the buffer a pure property portfolio never has. So when you step back and look at the whole wheel, 8 distinct income sources sitting across a genuine growth and defensive split, multiple geographies, a mix of contractual, dividend-based, and interest-based income, and a liquidity spectrum from cash right through to private markets, that's a completely different animal to one house, one tenant, one exit. No single sector, no single country, no single liquidity profile, and no single income type can single-handedly derail the outcome. If a listed property has a soft year, infrastructure and private credit can carry income. If equity markets wobble, bonds and cash provide the ballast to avoid forced selling. And critically, because a meaningful chunk of that income is tied to inflation-linked or floating structures, infrastructure tolls, rent reviews, floating rate private credit, the portfolio is explicitly designed to protect purchasing power, not just produce a headline yield. Which takes us right back to where we started. Real income, not nominal income. Real income isn't about chasing the highest yield. It's about building an income stream that can actually keep pace with the cost of living over retirement. And you don't get there with one asset, one income mechanism, no matter how comfortable and familiar that asset feels. You get there through genuine diversification of assets, of income type, and of liquidity. which is exactly what the Mont Wealth Income Portfolio is engineered to do. If today's episode resonated and you're considering how to diversify your assets and income generation, please contact us. Details are in the show notes. Please like and follow the podcast so we can build our audience and guest presenters. And as always, this episode is general information only, doesn't take into account your personal financial situation, needs or objectives, and it isn't personal financial advice. If any of this raises questions about your own situation, that's exactly the conversation to have with us. Thanks for listening. Have a great day.